Hello, my awesome accounting students. Welcome back to Chapter 7. Chapter 7 is all about transactions for merchandisers on the sales side of the house. Let's get started. We've completed the accounting cycle for a service-oriented firm, someone who sells services. Think of a salon or a personal trainer, a doctor, someone that has sold a service. We're done with that. Now we're changing our focus to merchandising entities. There's three major types of business forms, and there's some hybrids as well. The three types of business forms are a service-oriented business, like we just got done studying, a merchandising business, which is the focus of this chapter, and then the manufacturing businesses, which actually create the goods that you and I use every day. This chapter focuses on merchandising entities. Merchandisers buy and sell goods in the same form. So think about the stores you see on your way home. Some of these might ring a bell. And what they do all day long is they buy merchandise and they turn around and sell it to the end consumers at a marked up price. So in this chapter, we're going to look at the sales side of the house. We will be looking at transactions that any merchandiser makes. This will require that we learn a whole nother set of accounts and that we change the way we do our journal entries. I'm eager to teach you about merchandising entities, and I hope that in the back of your mind, you'll picture yourself in one of them to make the transaction seem a whole lot more real. So we have a whole new set of accounts for merchandisers. Remember, as we're learning about each of these new accounts, you should ask yourself three things. What type of account is it? What is its normal balance? And which financial statement does the account go on? Sales is our main revenue account. It's replacing the fees income, which was an account used for a service-oriented business. Any merchandiser that you can think of has its major revenue account as sales. The next account is sales tax payable. In some states, sales tax must be collected. California is one of those states. The companies don't get to keep the sales tax payable, but they collect it and remit it over to the proper taxing authority. Sales tax payable, like any other payable, is a liability whose normal balance is a credit, and like all other liabilities, it will be on the balance sheet. Sales discounts is a contra revenue and will be used to hold early payment discounts that are given to the buyer by the seller. Sales returns and allowances is a contra revenue account. Its purpose is to track the products that are returned by the buyer on the seller's books. Like any other contra revenue account, its balance is a debit and it will be found on the income statement. Last account is called credit card expense, and as its name implies, it's an expense account. That means it has a debit balance and it will be on the income statement. It's used to track the fees charged by credit card companies to the seller. This is a good slide to mark to go back to and look at, as we will be using each and every one of these accounts in the journal entries. There are 4 different types of sales transactions that any of these retailers or merchandisers would have. Picture yourself in one of the retailers that you see on the way home, and picture yourself just watching customers walk out of the store. The cash register would have rung up any one of these 4 different types of sales. So we will take a look at cash sales, where cash changes hands right at the cash register, a sale on open account, where the company has an open line of credit with the seller, or now more popular these days are credit card transactions using bank issued credit cards like Visa or MasterCard, and non-bank credit cards like American Express. Let's take a look at each one of these different types of sales transactions. In this first cash sale, the company sells $500 worth of goods plus tax of 8% to a customer. As we mentioned earlier, sales is the major revenue account for merchandiser. It is credited for the amount of the actual sale. In addition, the company needs to collect the 8% sales tax. So the $40 is the $500 in sales times the sales tax rate of 8%. The cash that is collected for the sales is equivalent to 108% of the amount. 100% represents the sale itself, and 8% represents the taxes. So the debit to cash is 108% times the amount of the sale for $500, or you can simply add the two credits together. This is how we record a cash sale. The second type of sale is a sale on open account. In this case, we sold merchandise of $600 with another 8% tax rate. So just like we did before, we credit the sales account for the amount of the sale, in this case $600. We credit the sales tax payable for 8% of $600, which in this case is $48. The only difference is, instead of debiting cash like we did on the cash sale, we will debit accounts receivable. Accounts receivable is used to record the amounts owed to us by customers that purchase on account. The use of credit is considered to be one of the most important factors in the rapid growth of businesses today. Companies often take bank credit cards for sales. This shifts the risk of collection over to the bank. Today, the two most widely accepted credit cards are Visa and MasterCard. These are known as bank credit cards. The way it works is that companies usually get cash deposited in their account within 24 hours, but the bank charges a 3% discount fee or something similar in order to process the account. By the way, that surcharge, that 3% surcharge, is charged on the amount of the sale plus the tax. So in this case, we have a company that sells merchandise of $900 to customers who use their bank credit cards. There is an 8% sales tax in this state. So the first step is to calculate the amount including the tax. A shortcut here would have been to take the $900 times 108%. That would give you the $972. That's the amount subject to the 3% bank fee. $972 times 3% is $29.16. What this means is that within 24 hours, the company that sold the goods and accepted the bank credit card will have a debit to their cash account in the amount of $942.84. Let's take a look at the journal entry to record this transaction. Here you see the cash debited for the $942.84, which was the amount of cash after the discount. You see the credit card expense of 3% computed on the previous slide. you see the amount of sales revenue that's always equivalent to the amount of the goods sold. And you see the sales tax of 8% that again was computed in the previous slide. This type of transaction causes the most trouble on exams. So take a moment, consider rewinding the video, and look over the calculation and journal entry one more time. Non-bank credit cards, like American Express, are handled a little bit differently. American Express and Diners Club make you wait a week or two to get the cash. Because of this, we debit accounts receivable when the sale is made, and then a few weeks later, when the cash is collected, the cash is recognized less the 3% fee. Let's take a look at the journal entry. Just as in previous transactions, the sales is recognized, the sales tax is recognized, but instead of debiting cash as was done on the non-bank credit cards, we use accounts receivable. This is because the money won't come in for another week or two. When the funds do come in, accounts receivable is credited for the full amount. The credit card expense is recognized for the percentage that the company collects, and cash is debited for the remainder. The difference between a non-bank credit card like American Express and the bank credit cards like Visa and MasterCard is the debit to accounts receivable at the time of the sale. Once again, take a minute to look over these previous two slides and make sure that you understand how non-bank credit cards are recorded. It's imperative that you understand each one of these 4 sales transactions before we proceed any further. This is Professor Johnson signing out.